So MOAT is a growth ETF that's currently gaining lots of popularity. I'm sure you guys are familiar with it. The current assets under management is $10 billion with an expense ratio of 0.46. That's not good. It's also not terribly high. And the overall performance over the past 5 years has been market beating. And this is why MOAT has been so popular recently. But in today's video, I want to give you guys the alternative point of view when it comes to this very popular, well-performing ETF. Now, I'm not saying MOAT is a bad fund by any means, but I want to give you a legit warning that you might not be aware of. Okay, so MOAT is designed to replicate as closely as possible before fees and expenses the price and yield performance of the Morningstar Wide Moat Focused Index, which is intended to track the overall performance of attractively priced companies with sustainable competitive advantages, according to Morningstar's equity research team. So right there, how could you possibly not like this fund? Wide economic moats, aka competitive advantages, fair valuations, and all curated by a very reputable company, Morningstar. Well, I think this article on Seeking Alpha did a pretty solid job explaining why, and I'll go ahead and leave it linked down below. But the key thing here is past performance is not an indicator of future performance. This is something we all think we're fully aware of, but the reality is most people still put way too much weight on historical performance when evaluating especially actively managed funds. And if I had to guess, this is the core reason why MOAT is blowing up in popularity over the past year and a half, because the historical performance has been so good, and people think, as they always do, this will continue into the future. Now, okay, you might think that MOAT is the exception to the rule because, after all, it invests in companies with sustainable competitive advantages, trading at attractive valuations. But at this point, I would stress to not fall for the marketing or the idea behind a fund. Because the S&P 500, this boring index we're all familiar with, also invests in companies with some of the highest economic moats to ever exist, even though it's not directly in the marketing of this fund. It goes about it in a different way. Of course, here this is market cap weighted, but it accomplishes the same thing because, simply put, companies that are able to deliver above average market returns over time tend to see their weighting in the index rise. So the cream automatically rises to the surface, giving you exposure to the best of the best without the need of a complex, convoluted investing strategy. That's one of the reasons why the S&P 500 is such an incredible benchmark. The 5 largest holdings in the S&P 500 right now are Microsoft, Apple, Amazon, Nvidia, and Google. Large cap or even mega cap technology companies, which arguably have some of the best economies of scale and competitive advantages and wide moats of any company on the market. And they go on to point out that Apple and Nvidia are not even owned currently in MOAT. Now again, at this point you might be thinking, mega cap tech is overrated, I want to invest in more exciting, smaller, lesser known companies. And that's fine, you can do whatever you want with your money. But the reality is, in the past decade, every time somebody said that large cap growth is done for, its best days are behind it, they have been wrong. It seems like the larger these companies get, the more efficient they become, the more products they offer, the more people they service, and the wider their moat becomes. In fact, the main reason why the US equity market has been such an outperformer, especially when compared against even European equities, is because the European market lacks dominant large cap tech companies. So even though they're not very exciting, companies like Microsoft, Apple, Google, Amazon, Meta have proven themselves to be very strong compounders with wide economic moats. And you have to ask yourself, are you investing for excitement or to make money? And currently these names are not very large holdings in MOAT. Rather, they invest in companies like Wells Fargo, Charles Schwab, Domino's Pizza, and Campbell's Soup. So to summarize my 3 points, point 1 is past performance is not a good indicator of future performance. And that's especially true as you get further and further away from broad market strategies. Point 2 is the lack of mega cap tech found in MOAT. I understand it's not exciting. You might want to have smaller, lesser known companies that you invest in. That's completely fine and legit. However, I believe large cap tech companies are some of the strongest, most well-positioned companies to ever exist, and they're not heavily represented in MOAT. And point 3 here is to not get caught up in the hype of the moment. Right now, MOAT has nothing but positive things being said about it because the past performance has been market beating, and it's kind of unique, right? It doesn't just have large cap tech companies. But I've seen this happen multiple times before. One example that comes to mind is the ARK Innovation Fund. In late 2020, this was all the rage because look at this chart. Huge outperformance. The investing strategy was different. It was innovation, and they didn't just invest in large cap tech. They invested in smaller, lesser known, more exciting companies. And people thought this outperformance would continue indefinitely into the future. However, we all know how this ended. And I'm not saying that MOAT and the ARK Innovation Fund are on the same level. I think MOAT is a higher quality ETF. I'm just using this to illustrate my point. So that's why I personally am not going to be investing in MOAT anytime soon. I understand that the recent past performance has been really good. There's a ton of hype around it. The methodology, the holdings are different, new, and exciting. But I know better. I've been investing for almost 10 years, and I know how this story ends. And in my opinion, the next 5 years, MOAT is very unlikely to continue to outperform. I'm not predicting it's going to crash and burn anytime soon, but I just don't think it's going to give you alpha over other high quality investments, especially considering that it's missing mega cap tech, which have been the primary driver of returns in the US equity market. That's it for this one. Hope you guys enjoyed. Peace.